send it to you. Rachel is here moderating. She will make sure that you get emailed, or make sure that Michael actually has the information to email you about the chart of accounts. Right, it's the price I pay for the @everyone tag, right? So I'm trying to give you value and making sure you're notified about that value. Okay, if you're angered by the little red dot that shows up on your Facebook account from the @everyone, then this is not the right group for you, and you probably should leave. And I don't mean to say that in a mean way, but we want a lot of positivity. I have well over 75%. I did a poll, and well over 75% of people wanted to know when we were doing trainings, and so that's a very large majority that wants the @everyone tag. And I'm finding it's like 1 or 2% people get really angry, but they're also the most vocal, so it looks like that's out there. So I know from my own polls and from the amount of messages I get on the positive end that the @everyone tag is something that people are wanting. I did do it. So if it doesn't know you, but you still want to stay in the group, I did a training yesterday. It's in a live on how you can go into your profile and disable the @everyone tag. So if you don't want it, you can actually control that yourself. And I actually teach you how to do that in my post yesterday. Okay, so I'm just trying to serve you well. There's no harm meant to anybody, but I also have to consider the needs of the many over the needs of the few when it comes to this. Okay, so if you're angered, which I don't understand why that would make you angry, but if you're angered by the @everyone tag, I apologize. I showed you how to get rid of it yesterday. If that's not good enough, then you probably should just leave the group, and that's okay. You have the right to do that. Okay. So here's your chart of accounts, comment chart of accounts if you want that. And then Rachel, also interrupt me. It's okay to interrupt me if there's some active questions in this group as well too. All right, so I'm going to go to the next step on this after we've set up our chart of accounts. You can mimic it to be like your chart of accounts here. Here's one that I did starting in September, but as we do your budget one, and I will do this for you. Like, I'm showing you this software. I will give you my software for 60 days in my next group. It starts on January 2nd. You can put a comment 60 days, and Michael will message you and tell you what you need to do to get in the group. It is free what we're giving them, right? And so we're giving you our software, which takes up space on our Amazon servers and creates work for my team to set up and put your employees in and link it to your POS system. And there's a whole bunch of work that goes into it on our end, and we're giving that to you. And so if you are not serious about it, we don't want to waste our time, nor do we want you to waste your time with something that you're not committed to. And that's okay. Maybe right now is not the time for that. Everybody's ready at different times for this. However, every single client I have always says they wish they had done this and operated with my systems since the day that they opened. They would have saved so much money, saved so much heartache, saved so much time. And those are things you can't get back. But sometimes you're not ready for the message. We had a couple of people say like, hey, I'm just too busy to be able to do this. And my answer to that is this is work that you have to be doing either way, whether you're doing it through my systems or not. So you might as well take my help, get you going over the 60 days, because 60 days is going to pass no matter what, right? The one that starts on January 2nd will end on February 8th and February 28th, excuse me. And no matter what, that time is going to pass. So you might as well take that time and move your business forward, right? And what I know is that I'm right and that it will help you. And that's what's given me the courage to go ahead and give this much away for free, because we have all of these systems in here. I click here and I got sales forecasting, end of day reporting, purchasing systems, invoice logs, invoice upload, paid outs, manager logs, data, checklists, employees, employee hubs, employee logs, availability, schedules, labor budgeting, which is the labor allotment, reverse labor, which is how I analyze schedules, food systems from products to inventories, and recipe costing cards and key item reports for profitability, prep sheets, auto pars, prime cost reports from cost of goods sold, budget variance, end of month inventories for accounting, a whole bunch of resources, which are training systems and you name it, all these resources, workshops that we've done, training systems with lesson dashboards, analytics to keep your team accountable, budgeting, which is what I'm in now. Actually, I'm gonna go back to that. Budgeting, other benefits for loyalty to credit card processing stuff. So anyways, I'm going to go here. I've pre-set up this, here we go, category settings. Anyways, we're giving so much away. I just need you, it's a mutual understanding that I'm going to respect your time. And so we ask you to respect ours. And that's the only cost to being in the group. And it's up to us to prove that we can save you. The average savings is 10 points on revenue, 10 percentage points on revenue. So if you're doing a $50,000 month, on average, people are saving $5,000 in their prime cost expenses, which is absolutely insane. And it's the reason for that is most people are running in the 70s on their prime cost. Most restaurant, and that's what makes most restaurants the average restaurant. And so if we look at what that looks like, we're going to go into our budget and I'm going to show you what this starts with. So here we have, I'm started with a budgeting template where it's all in here. I've broken down. Now it could be different for your restaurant where we have food, liquor, beer, draft wine, any revenue center here that we can separate on an invoice. Okay. So I can tell the difference on the invoice between a bottled beer that I buy and draft beer that I buy. I can also tell the difference on my POS system. I can see that I've made a draft beer sale on my POS system, a bottled beer sale. So if I can separate that, I will. Okay. So if I can separate any of those revenue centers and the cost of goods sold centers, I'm going to do that. And so you can see here that we have corresponding cost of goods sold centers with revenue centers. A lot of accountants make the mistake of creating a different, I don't know where it started because it's not even a generally accounting principal chart of accounts item, but people will do like poultry, dry goods, meats, dairy, produce in their cost of goods sold is a big mistake that I see. And what happens with that is you don't really get a good report card for your business. So I may see like, oh, here I have dairy costs, right? And then you'll see like their sales, they may be separate, like, oh, I have catering sales or Uber sales or DoorDash sales or credit card sales, cash sales, and all these accounts where they're tracking revenue. That's not really the right way to do it. Okay. So the correct way is, and this is where our system to actually help you track this easier and actually help pull in your revenue from your POS system and separate it in the way that we want to be. And if we need to help you change your POS system, we give you guidance on that to fix that. But you can see here that we have cost of goods sold accounts. So like, for example, I always like to use chicken wings as my example. If I am selling a plate of chicken wings, well, it has produce, it has carrots and celery, it has spices on it, it might have the Frank's Red Hot, that's all dry goods, right? I have poultry in the chicken wings, I have fryer oil, I have dairy in the blue cheese dressing, and so I have all these different accounts, but it's generating a food sale. And so what will happen is all of those items will be a food cost and they will correlate with a food sale. Okay. With that. And so that's how this is one way that it's going to be. This is like a non-negotiable on how a restaurant's chart of accounts should be set up as far as revenue. So it's important to go look at your own, and we can help guide you to fixing it and all that. Too, when it comes to payroll, I have this one is it's actually been broken down to where you have, okay, I could have just front of house, back of house. This is where I'm going to be, I'm going to want to separate it out on how I actually use it, right? So if I have a busser schedule, I'm going to be scheduling bussers and seeing how they, on how many hours I can schedule, right? Hosts, servers, barbacks, bartenders, all these departments that we have, right? Or I could just have front of house, back of house, depending on the size of your restaurant. Like if I only have one host, do I really need a schedule that's only hosts, right? I might have a schedule that is mark somebody as host as their station, and there's part of a front of house schedule. So from a restaurant that is 250,000 a year to 20 million are using my systems. Okay. So it just depends on how we need to set this up, and we'll customize it to you to make sure that we hit that. Okay. So when we're entering our sales, we'll look if you have a history at all. We'll just pull like what you did last year. So, like for example, you did $100,000 in January and $90,000 in February, and then a lot of times people start to get busier. So $110,000 in March, maybe $120,000 in April. May gets busier. Get Mother's Day in there. Okay, this is typically what it looks like. And you can just go grab last year's sales when it comes to this, right? So I just plugged some numbers into there. Then what we'll do, and what you have to do, is the mix. The way your sales come in is really important to budget. So for average restaurants, a lot of times, food will be 80% of sales that come in. So if I say, hey, on average, 80% of the sales that come in, I'll show that on $100,000 month, I'm going to do $80,000 in food, right? And so this will be different for every restaurant. And so it's just going to depend on, where you're at with that. And I'm just putting in some percentages here that can help me track these numbers, right? So this would all need to add up to 100%, right? And so what we say is on average, this is how our sales will do. So based on the rest of that month, if I right click, I can use this budget basis in here, and it will copy that across for me the rest of the way. And it shows me in here as I'm budgeting. And now, and understand this, we're setting up our budget the way that our books are, right? So that we can budget the way that we want our P&L to look. And then we're going to plug our P&L in here to see how we actually did. Okay. And that's a really, really important factor in all this here. Okay. So the other part to realize is when I look at food, and let's say I want a 25% food cost, right? But maybe I'm running, and this is where most people are having problems with right now. If I'm running a 40% food cost, right? So 40% of 80,000, that's what I want you to know that it's of just the food, right? So it won't be $40,000 because it's 40% of the $100,000 up top. This is of food costs, right? So 40% of $80,000 will be $32,000 when I put that in there. So when I put in the 40% of food costs, it's showing me how much I'm spending relative to the food costs, right? If you're running a high liquor cost, you'll be running at 25. If I'm running too high of a draft beer cost, that would be 30. If I'm running a high bottled beer cost, it might be as high as 35%. These are all numbers I've seen, maybe 45% on the wine. Merchandise is getting stolen, 75%. We go in and we plug in how you're actually running, right? And so these are all where you're at too. Now, what it'll do is now the overwhelming majority of this is weighted towards the 80% of sales being food costs. So you can see here the cost of goods sold is weighted towards that as well. But overall cost of goods sold for the whole area is this 39.15, right? So if I right click, use as budget basis, yes, there we go. We have that. Okay. Then we get into payroll. A lot of people are running high payrolls here. So when I look at this, usually salaries being, let's say we have a, I don't know, $6,000 a month owner salary. Okay. And then we have management salaries of two people at one at, let's just call it, 10,000 a month for two people. I don't know. Like that, not 100,000 a month, 10,000. Right. So I want you to see that I've entered these in as fixed costs, right? But then when we look at, overall back of house labor and front of house labor, like maybe our back house labor is at 9% and our front of house labor is 9%, and our back of house labor is at 15%. Okay, without filling in all the other areas there. Okay, then we have maybe for employee benefits it's $100 in prizes we give out, and then we have our um payroll taxes, which this area it's a percentage of payroll, and restaurants run higher, so it could be a 14% of payroll because restaurants bring in tips and you have to pay payroll taxes on tips, so it's a higher rate than say like my business where my employees don't make tips, and so I'm just paying payroll taxes on the money that I pay them. You as a restaurant owner are paying payroll taxes on the money that they bring in. So all the tips that all your servers earn is not money that you're paying them, but then you're at paying taxes on the payroll taxes on that money that they're collecting in tips. And so it makes it a higher rate than another business, which I don't think is fair for the restaurant industry at all, to be doing that. But that's just part of the reality, right? And then so we might have workers' compensation. And then, hey, if we're a restaurant that's running the numbers that I'm putting in here as a budget, no way. That's probably more than that. It's called 500 a month on the workers' comp, $6,000 here. Probably more than that, even actually, probably more like $1,000 a month here. Okay, so you see how we put that as a fixed. The rest of these are variable. That's fixed. Now we have a prime cost budgeted here, right? Or not budgeted. We're actually just the way we start this is we will put this in, and these are typical numbers that I see restaurants running. Okay, when we start working with them, right? In the beginning, it's just a matter of setting new targets. And we can see here that I'm updating this across the board. The system's doing the work and pushing these numbers across for the year. Okay, so when I see this, you can see that the $10,000 is the same as a fixed expenses as we go across here, right? But then I have variable expenses that go up and down, right? So you can see here in May at $130,000 a month that we're doing way more in variable labor than we're here, but our fixed costs are still the same there, right? So I'm gonna hit save on this budget. So you can see here pretty quickly, especially if I have your numbers, that we can build a model for how you're operating pretty quickly, right? And so we'll just ask you to provide that. So without any other expenses, you can see that we're in here. This shows me this is a prime cost of like 86. That's pretty high. I see it though all the time. This is going to be a restaurant that's losing money if they're operating like this, like for sure losing money. Okay. And then we go through operating expenses, advertising might be a 1%, cleaning, maybe it's 1,000 a month, $100 a month for lawn care, maybe a 0.75% on linen, casual labor, a little bit a month, dues and subscriptions could be, it could be like the Chamber of Commerce, whatever that looks like, right? Utilities to 2,500 a month. We'll plug in your numbers here, right? So I have utilities, but we could have all of these numbers here, like telephone. Usually we have a advanced system in here. So I'm essentially just budgeting everything that we can have in here. Okay. And if I'm looking at this like credit card discounts, so this is 2% on total sales means I would want you at a lower rate. If you're 2.5, you definitely need to shop it. But that's kind of, so that would be $2,000 a month on that, because we're not doing all of our sales are not on maybe your $80,000 of that was on credit cards, right? So that's what gets us to that like 2.5% in there. So we put in there that's fixed and variable. That will give us a break-even point down here. I actually didn't let me put rent in, because rent is always going to be like a big number on this restaurant. So paper supplies would also be a big number, 2%, 1%. Where's my rent? It's important to building it. Okay. Sorry. Okay, so I want to plug that in just because it's the biggest one. So normally when I'm setting up a chart of accounts, but the default chart of accounts I give you will be where is rent? Cable. Maybe rent wasn't in on this, right? Too. So watch what happens if I hit right click and I do edit category. here, and I can even insert after, right? I can edit this to add whatever account that I need, and it probably is there. I just didn't see it. So if I do rent / lease, right? That's a big expense. So what I do in my chart of accounts that I give you, if you requested it, is we put actually in your operating expenses instead of doing it alphabetically. We do it from the biggest expense to the list. So usually in operating expenses, rent is your biggest expense in there, and then it will go down from there to like utilities and things like that too. But that's something that that's really important to calculate. All right. So I entered in rent, the rent / lease in there, and I can control it and put it in anywhere that I'm at. Now, I normally would want a place to be 6 to 8% on that. So let's see. So $8,000 would be in that range. And that is software is going a little slow because of Zoom. All these numbers that we plugged in here. It's not all the numbers that we're going to need, but all the numbers are definitely plugged in here. Okay, so I'm going to hit save on this. And so we plug all these numbers in, and we end up getting a break-even point down here. Now, if you expand this, if you can see here that we have this break-even point, and it's $94,000. We have a training that I did on break-even point that shows you exactly how you should be operating in a break-even point, right? And so it goes through the calculation on those fixed expenses versus variable expenses and how you do it and how it calculates. The software will calculate it automatically for me here, but so let me go to my dashboard. Go back in there. Not sure what's going on with that. All right, so the software will calculate it for you automatically, but I gotta move. Okay, the software will calculate it for you automatically, but you need to understand what's going on in the background. So you got to understand contribution margin, you got to understand variable expenses, and it's really, really important because the restaurant business is full of variable expenses, and QuickBooks will not let you budget variable expenses. QuickBooks will neither will actually not any other. There's nothing out there that will do it, and I'm not going to name other. Well, actually, the only other restaurant accounting software on the market, but it doesn't do it either, right? And so that's a really important factor and all that. So let's see, we're going to go to our, where's my rent? I want to plug that number in. Okay, and I'm going to go right click. I can do use as budget basis on that, but I'm going to hit save so it calculates on that. When we look, and I haven't even entered in all the possible operating expenses, and I'm pretty sure this restaurant would be a loss because of the, yeah, look at that. That restaurant's at a loss because of the 80% prime cost, right? And so where I want you to be is somewhere, especially if you're doing 100,000 in a month, is somewhere in the 55 to 60 range. It used to be easy 55. It's a little bit difficult right now, but easily in the 60% prime cost range, which would be 26% savings on this, right? And so as we'll go in and set targets, that are based on that, say, okay, what are we going to do? We're going to at least get, food cost to 35%, and then liquor we got to get below 20, and draft beer will get to 22%, and bottled beer will get to 25%. Okay. And then our wine costs, we're going to get to 35%. Merchant, and a lot of this is just one, we're setting targets, but then we're also going to put systems in place to control this all, right? So we set those targets, and okay, now we're down to 33.31% on that. We're going to look at our payroll. Well, we're not going to be saving on salaries, but we're going to want to get this down to 13%, and we'll get this down to like 8%. We're not going to cut that too much, right? I'm probably actually even get down to 12% in our kitchen. That's where we want to be super efficient with that. That's going to be an overall 20. The rest of those are fixed costs, and they'll calculate off that. We had an 86% prime cost. And then so now we've set targets in here that allow us to get to where we want to go. Okay. And so here we close this, and I'm gonna hit save, so it will calculate here. And they did. I know this is all riveting stuff, but it's so important for the restaurant business. And so just like that, we lowered their prime cost to 76, and it changes their world, right? And so we didn't go, like I told you, I ultimately want to get you to 60. We'll just lower the bar a little bit and then put in systems for you to control, and then eventually we'll get you to that. Okay. And so that's where we want to be. So then we said, okay, here's where we're at. I'm going to take my actual numbers and I'm going to import them in here. Okay. And it's really, really important to, look at that. And so what we'll do is we'll be able to create a P&L that feeds directly into here and allows us to compare what we've actually done here too. So there's gonna be different things that we have to do, like different payroll accruals, and it's also a flex budget. So if I'm looking at this, you can see that my food cost is 35% as my target, which means on 80,000 I would be, doing 35,000. When my actuals go in, if I did $100,000 in food sales, which is more than the 80,000 I projected, which also means I should spend more than the 28,000 I budgeted, right? So it means I should spend $35,000 on food, right? And so that number is then calculated based off the actuals that we input in the system. And that's really, really important to understand. So now this saying, hey, I should have spent $35,000 on food based on the 100,000 that I actually did in sales, right? So it's going to give you pluses and minuses, variances, and where you're at. And then when you do your actual calculations, this will actually feed in from our management software here. But let's say you actually ran a 36,000, you did $36,000 in your food expenses, all adjusted for inventory. All those calculations happen. It's gonna say, hey, we were $1,000 off of where we should have been, right? Even in labor, it's based off the $100,000 in sales. So it says 8% would be, I should have spent $8,000 on front of house. Too. The other thing we're going to solve with this is when I look at a calendar and I look at, this is January. Okay. Let's say your biweekly pay, right? If that means Sunday is the first, right? We're gonna look at Sunday the first all the way to the 31st of January, right? So most of us are biweekly, most of us are a Monday to Sunday work week, right? So let's say that a pay period ended on the first, right? Well, that you would have a paycheck that hit on Friday the 6th, right? Well, this paycheck that's being recorded in January has it's really December 19th through um January 1st. And it's being recorded on January 6th in your books. And the reality is you're going to show sales that are from the 1st to the 31st. But if you're recording by paycheck date, then you'll record this one on the 6th, and you'll record this one on the 20th, which will be the 2nd to the 15th, which means to the sales from the 1st of January to the 31st of January. And that is just dead wrong. right? And so you can't actually compare that to your budget because it's not even lining up. You were closed for Christmas, maybe you were closed for New Year's Day, maybe maybe you were closed New Year's Eve, or maybe you did a huge night on New Year's Eve. And it skewed your labors and sales and all that. And you have all this labor, but none of that New Year's Eve sales in that payroll, right? So it's just off. It's not a good traction. So a way around that one is period accounting, that you run 13 4-week periods, that your labor fits nicely within those periods. That's one way. The other one is a 4-4-5 accounting, which gives you 2 4-week periods and a 5-week period that makes it easier to accrue that payroll. And you're comparing, Mondays to Sunday, 7 days this year to 7 days last year. Or what I've built in our software is the automatic payroll accrual. Since we're pulling in all your labor from your POS system, I actually got to show it in my demo system. I'll show that to you right now. These automatic payroll accruals, right? And so what happens in my system is you take these labor budgets that you have. Let me go log into the system here. You take these labor budgets that you have and record them. Let's see, get logged in. So I'm going to go to this. Go to one of my clients. Okay. So when I look at this, I want to know that I have the right payroll. So if I'm going to, for example, I'm going to go to my accounting section here. I'm going to go to my payroll accruals that we have here. And I'm going to say, hey, I want a payroll accrual for the month of September. Okay. And what it does is it knows that I've entered in. So in my system, you enter your payroll weekly. Okay. And what happens is it knows that Monday, and they're Monday to Sunday week. So it knows they entered in a payroll that was Monday, the 29th of August. So I just said I want my payroll for only September, right? So it knows I entered in payroll that from Monday, the 29th through, right? And so when they enter it in, what happens is they automatically calculate. So the week of that 829 total was $26,000. Well, we calculated that $12,000 of payroll was from August 29th to August 31st. It backs this payroll out. These are the actual hours worked. It pulls it right from your POS system and tracks it. And it says, okay, so that means that this is the exact payroll that is for the 1st to the 4th, because the first 3 days were not in August, right? And then the 5th to the 11th is the full payroll in there, right? The 12th to the 18th, the full payroll, right? I don't need to do anything. The 19th to the 25th. But then I get to the 26th to the 30th of September. Well, the total one was there, but then it tracks, hey, with those payroll for that week that fell into October, it will back this out of that, right? And this is what's left over that's just September. So now I have a true payroll that's only September. And then in the accounting, it does the automatic accruals for as you run the P&L for it. Then it takes all my salaried people and it knows what their salaries are, and it will calculate it based on how many days are in that week for September. So now you have a true payroll without having to switch to period accounting to compare to budget, to let you know exactly how you operated. The beauty of this is I get you a P&L. A lot of times the delays in getting your P&Ls from your bookkeepers and accountants are that they're waiting for the payrolls to come through so they can reconcile. What this does is this gives me a preliminary payroll report for my P&L as of, this one would be for September. So as of October 1st, we know it, right? And so we don't have to wait to get our preliminary P&L, okay? Two, we have our balance sheet, right? And so we're launching the balance sheet, and so we can go and choose. The balance sheet always goes from the beginning of the year. Now you're going to go and choose an inventory, right? And know, hey, I have this inventory that I've chosen. Here's one on November 27th. Load. I have my balance sheet in my system, and it's all being taken care of automatic from the work I'm doing in sales in my end of day reporting and bill pay and all of that stuff in there, right? And then it will, let me actually go to a fake restaurant here. Okay, and switch. All right. So if I go, hey, I want to choose my inventory date, which would be, I don't know, let's say I have a November 27th one here, right? And load, it's going to go from there. All right. So we have, hey, any accounts receivable, total assets, liabilities, gift cards, all of our balance sheet stuff is all in here. You can pay your bills through the system so that you can see where you're at. We're going to be connected. We're about to be connected where you can actually do ACH right through the system as well. You can take credits, pay bill, just check off bills and pay them and print the check out. It marks them appropriately. You can reconcile. Getting your invoice upload here. So, any invoices that are being sent in the system that are being processed, this is, I'm not sure what we have here. So there is a, or a PDF that can be uploaded there. Benny Keith, Del Monte, we're doing that. Arizona Beverage, Gucci Foods one. If I hit that PDF, it's not the actual system. Let me go over here in the actual system and do it. So I go daily paperwork. Okay. All right. And then we're going to go right to our system. There we go. We go to our daily paperwork. You can go to that invoice upload, and you can see here that, in our system, you don't have to process invoices. You just go right into it. There's that Fuji Foods one I was looking at that wasn't in demo. But here's what that picture looks like, right? And so here's how you upload your invoices, and we track not just the accounting codes, but every item needs to be tracked, right? And so that is an accounting best practice, is you got to record all of these things, and you got to have payroll accruals as well. The other thing is weekly inventories, right? So if we're going to be doing this, we got to be doing weekly inventories to make sure we get this right. So if I go here in my prime cost section here, the end of month inventory can be calculated, right? And so if I want to calculate an inventory for, let's say I want my month in October inventory, right? And if I choose an inventory that's going to be the closest inventory to October 31st, which the 30th is awful close, right? So I can get an October 31st inventory because they'll say, hey, here's the last inventory. There's the usage rate. That's what the sales that happened on one day. Estimate how much product disappeared from the shelves for whatever reason. There wasn't purchases on that day. And so it says, it'll tell me a day later, what my inventory should have been based on how much I sold and where it's at. Let's say I'm a little bit further away. If I want an end of month for September, right, then I'm going to choose that closest inventory to September 30th, right? And so that would be October 2nd would be that one, right? And so we'll go the other way, right? So it will add back that inventory if I'm going the opposite direction, right? So automatically we can get an end of month inventory, and I can just hit a button, and all of a sudden I have an end of month inventory for my accounting just like that. And because it's part of your inventory system, it's all in one spot, and you can count it and add it and do it in an app and all that stuff too. So we go to inventory here, and you can see where we're actually counting that inventory here. So if I look here, here was a Christmas Day inventory. You can see here we got food stuff in here. All the stuff can be in here. Walk-in cooler, a whole bunch of things were in there. It tells me by location, so I can see if there's a mistake in inventory where I'm at. If we click here, hey, here was my walk-in cooler. Any notes in here? We can drag and drop things if they're in the wrong spot. You can see that that's a recipe that's being inventoried, which tracks all the products, all of your groups. So if I'm buying whole milk from, that means that I'm buying whole milk from, two different vendors, or same vendor, different product from the vendor. We're getting that all the time, where products are being changed out and we got to go and track them and get them. So how many in the count that we have. So here's the count here, how many were counted. If I'm at, the storage unit, let's say I know I have a case, I could change to the purchase unit, which is the 4-gallon here. And I can say, oh, I have one of that, right? And I can change that number in there, right? Inventories are so important to this whole process too. Rachel, any questions out there? I know we're in the.
Michael and I have been answering the questions on Facebook, and there isn't any in Zoom right now.
Okay, fantastic. Okay, so we want all of this connected and added in here. So we want a good inventory program. This could be something this is something that you get set up in the 60-day program with me. Let's say you set up your inventory and you go through the whole 60 days and you go like, oh man, I just did all this work and now you want to make me buy your software? Well, no, I don't have to. I can create an Excel from the inventory. I'm not holding anybody hostage. I know it's going to be easier because it's all connected in a database and it's there for you, but very easily you have everything you need right in here. So immediately this inventory sheet, yes, I trust the source, right? So now I have an inventory sheet that has been exported, right? So, I've been, people are just not nice, but accused of like, oh, you're holding them hostage and all this stuff. Nobody's hold hostage. Look at this. We have by location, reach in cooler inventory, line cooler, prep cooler, dry storage. It's all, you can download it. This is work you need to be doing anyway. So let's say if you get to the end and you decide you don't want my software, download the spreadsheet of your inventory and you have it there. It's in purchase units and you have your most current pricing and all that. You're going to have to manually update your price because it's not in the database, but that's fine. You decided that it wasn't right for you. That's okay. So there's a lot in here that you can do. Nobody's holding you hostage. This is work that you have to do anyways. So making sure that you have it in there is fine. The cost of my software, here's what I'm giving you. I'm giving you the $699 a month version in the 60-day program. I'm giving it to you, and that is the base cost of my software is $399, and then all the automatic invoice doing, because it's a combination of technology and real people that are processing your invoices. So I'm giving you the $699 a month version. And like I said, if it's my job to save you, more than 10 points on your sales, or even more than that, to be honest, what I want is that $699. If you're doing $50,000 a month, I'm thinking I can save you $5,000 at least, right? So depending on how well you're operating already, or how, because this is also just a matter of systematizing and getting your time back. A lot of times your spreadsheet systems require you to do them. So base software is $399. I'm giving you the $300 that's extra and for the invoicing for 2 months. And so we'll process every single one of those invoices. All you have to do is take a picture through the app and they get uploaded. Where's my phone? I can show you the app on the phone. I don't know about this. I've lost my phone. So there you go. Sorry. But I do have, all you do is take a picture in the app and they get uploaded here. So like these in this invoice upload, through our app that has checklists and ordering and inventory, you also can just take the pictures. And so this picture was taken through our app here, right? So you just open the app, you choose the vendor, take the picture, and then this gets processed through technology. It can scan this and see where it's at, but we also have a real person that looks at it. If it's your big vendors like Cisco, US Foods, Benny Keith, you just take a picture of the last page and then we pull that data from it. And during the 60-day program, we actually teach you how to do that yourself. So if you decide at the end you don't want to pay the extra $300, then you don't have to on there too. So hopefully that understands. And then, like I said, the 60 days is free for me to prove that I'm right. And that's the biggest thing is people go like, I don't understand what you do. Are you a POS system? No, we connect to your POS system. We connect to Toast, Focus, Micros, Aloha, Posy Touch. We're about to connect to Spot On. We're about to connect to Clover. We're about to connect to Square. So these are all coming. And I work with you every day for 60 days over this thing. So I go on live and I teach. And I teach in detail. And not only am I teaching, but I'm using your all of your system, all the people that are in the group, I'm using your systems to teach. So we get in there and we set up your inventory and we do your recipe costing cards and we do your budget and we do your training systems and we set up your checklist and we set up your and your schedules and we get your employees trained on the app to swap schedules and do all that stuff for your convenience so you're not having to do double entry. We set up all of these systems for you. And if you do your homework, then I'll work in your system and do your stuff. If you're busy and you can't attend, then you can watch the recordings. We understand you're busy restaurant owners too. So April, hopefully I answered your question there. There, I'm going to mark that there. With the cost there. So we want to make sure that accounting's done. We talked about inventory accruals. We talked about budgeting on your P&L. We talked about payroll accruals on there too. You're welcome, April. My pleasure on that. We will also talk, we'll get into where we're talking restaurant marketing and all that too. I don't talk about restaurant marketing until we get your operations in order, because if we open with marketing, if you're losing money, more sales will just help you lose money faster, especially if you start to understand that break even projection or break even calculation that I talked about. You can see how more sales, if my variable costs are out of control,